It seems like a truism in life that the rich stay rich, and that their wealth only seems to keep growing. But this isn't by accident. One of the secrets to their success is their wise and calculated use of debt. Debt is often rightfully seen as a negative thing that is to be approached very carefully. But when used properly by sophisticated and experienced investors and business people, it can be a powerful financial tool. Let's go through the 9 ways that the rich use debt to make themselves richer. Number 1. Leverage. The wealthy use debt to leverage their assets. It essentially means using borrowed money to increase their potential return on investment. Though it can be very dangerous if you overextend yourself, it's a strategy that has been used by successful investors for decades. Leverage simply allows the wealthy and financially experienced to control more assets with less money. For example, let's say a rich individual has $1 million in cash and wants to invest in real estate. They could buy a single $1 million property outright. Or, they could use leverage and buy 4 $1 million properties with a 25% down payment on each. By using leverage, they can control more assets and potentially earn more money in the long run. Leverage is usually seen in investments as well, with the aim of amplifying gains. But as with all investments, things may not always go according to plan. That's why they also usually have clear exit strategies in place. This is to cover the undesirable scenario of an investment going south, so that they are able to minimize risk and have peace of mind. Number 2. Tax deductions. Many countries around the world allow for interest paid on loans to be deducted from taxable income. This can be a significant benefit, and it means that the rich can use debt to their advantage. By taking out loans that have tax-deductible interest. For example, a wealthy individual could take out a mortgage on a rental property, and deduct the interest paid on the loan from their taxable income. This reduces their overall tax burden, and allows them to keep more of their money. Another example of this is when a successful business owner takes out a loan to invest in their business. The interest on the loan can often be written off as a business expense, thus reducing their taxable income. These tax deductions are just another tool in the toolbox for the wealthy to increase their wealth and reduce their tax liabilities. Number 3. Negotiating power. When you have substantial assets in a strong financial position, you have more negotiating power when it comes to debt. The wealthy know this, and use it to their advantage. Lenders see them as more valuable borrowers, so they are able to negotiate better interest rates, terms, and conditions because they have more influence and clout. Additionally, they have access to a wider range of lending options that aren't available to the average person. This means that they can shop around for the best deal and secure financing at lower rates than most people. By having this negotiating power, they also have greater flexibility in choosing which loans are right for them and their investment goals. Number 4. Cash flow. Cash flow is simply the amount of money coming in and going out of a business or individual. It's critical to monitor this, as a lack of cash can lead to serious consequences. The rich are all too aware of this, and use debt to their advantage to manage their cash flow and maintain liquidity. They may take out loans or draw down on credit lines to cover short-term expenses, such as payroll or inventory, while waiting for long-term revenue streams to come in. This allows them to keep their business running smoothly, without sacrificing long-term growth opportunities. This also saves them from having to divest or sell off valuable assets to generate cash. For example, they may use an overdraft to pay their suppliers, rather than having to sell off an investment property that has potential to appreciate further in value. Number 5. Access to capital. Another advantage of debt is that it provides access to capital that may not be available otherwise. The rich can use debt to take advantage of opportunities that require significant capital, such as starting a new business or purchasing an asset that needs a large outlay. This allows them to take advantage of opportunities that may not be available to those without access to a large chunk of cash. For example, They may be able to purchase a property or invest in a business that has the potential for high returns, thanks to their ability to secure a large enough loan, and at lower rates as well. This access to capital also means that they are not limited by the size of their own cash holdings when it comes to taking advantage of opportunities. Number 6. Credit score. A high credit score is an extremely valuable asset, and the wealthy understand very well how important it is to maintain good credit standing. They use debt to build their credit score, which allows them to access more favorable loan terms in the future. By consistently making timely payments on loans and credit cards, they strategically increase their creditworthiness in the eyes of financial institutions, and improve their ability to obtain lower interest rates and better repayment options on future loans. Additionally, having a good credit score can smoothen and improve other areas of their lives, such as getting lower insurance premiums. Number 7. Debt consolidation. Debt consolidation is the act of collapsing multiple high-interest debts into one lower-interest loan. This allows the wealthy to pay off their debt quicker and more efficiently, while also saving money on interest payments over the long term. Debt consolidation can be done with banks, credit unions, or online lenders, and it can be a great way to streamline finances and take advantage of lower interest rates. Banks and financial institutions are also usually pretty keen to take on this debt from the rich, even at lower rates, because they know that it's probably at a minimal risk to them. It's also more convenient as a borrower to pay down a single loan, instead of having to keep track of multiple repayment amounts and due dates. So it's a time saver and a productivity booster, in addition to the economic benefits. All in, it's yet another tool in the rich's arsenal of financial strategies, and can be used to great effect if done properly. Number 8. Arbitrage. Arbitrage may sound like a sophisticated concept, but it's plain enough once you break it down. It's simply a strategy that takes advantage of price differences in different markets. Where debt is concerned, it means borrowing at a lower interest rate, and then investing those borrowings into an asset that generates higher returns. For example, some investment products offer guaranteed returns at a certain fixed rate. As long as the rich are able to obtain financing at a lower rate, they will be able to earn the difference between the return of the investment product against their loan interest rate, which is called the spread. Arbitrage is a powerful money-making strategy that the rich often use, all due to their ability to get low-interest loans. Number 9. Diversification. The wealthy understand that diversification is key to managing risk and maximizing returns. Markets and assets can be unpredictable in the short term, and can go through ups and downs. The wealthy are well aware of this, and use debt to spread their investments across different asset classes and industries. This diversification helps them minimize risk if one investment doesn't perform as expected. It also allows them to take advantage of different market cycles and opportunities. For example, instead of investing all of their money in one business or industry, they might choose to borrow to invest in real estate, stocks and bonds, or even more exotic assets such as wine or art. By doing so, they are spreading their risk across multiple investments, ensuring that they don't lose everything if one investment fails, and also giving them the chance of capturing pockets of growth across different types of assets. Check out these videos next on investing.